My name is Michael Batnick. I'm sitting here with Barry Ritholtz. Hey, Barry.
Hey, Mike. How's it going?
You wrote a post called Endowments Shift from Hedge Funds to Private Equity with the byline, Ivy League endowments make the same old mistakes. Hedge funds and natural resources underperformed. New investments in private equity look no better. First question.
Yes.
Do you get to decide any of that? The headline or the byline?
That's an interesting question. You don't get to choose your own headlines. Writers submit a column. I always give them a suggested headline and a suggested byline. They rarely, if ever, use them.
So this is the 11th time you've written this article?
Feels like it, yeah. Remember, Harvard has gone through all these crazy permutations.
What's the TLDR on this?
So after piling into hedge funds over the past decade, come from the high fees, stay for the underperformance, a decade of mediocre returns, their endowments and pensions are moving out of hedge funds, mostly on the advice of consultants who are steering them to something else that's expensive and potentially underperforming private equity.
Okay, so you start the piece talking about the Ivy Leagues, which seem to get all of the attention, right?
Yeah, this is the time
giant
of year,
endowments.
Right, so the Ivy League endowments, they run a fiscal year. It ends June 30th. They all start to dribble out their returns pretty much around now, late September, early October. Most of them are out. The consensus expectations were for about 8.7%. Most of them underperformed. It turned out that Brown, which is the smallest of the Ivy League endowments, was the only one that did really well. It was an outlier, over 12%.
So you wrote the underperformance is consistent with the record of the past decade. None of them beat a 60-40 portfolio. Why is that a benchmark or a bogey that we keep hearing about? Why is that appropriate?
It's funny you say that because originally I include the S&P 500 and the 60-40, and the edit comes back from the editor with 60-40 taken out. And I pushed back. I said, listen, you can't compare a big endowment portfolio to a stock-only domestic index. That's not fair. So the standard measure, the famous bet that Warren Buffett did against a bunch of hedge funds was global 60-40 portfolio, 60% global equities, 40% bonds.
It was S&P.
Oh, that's right. That was, which is a very unfair comparison.
Well, but why is 60-40 fair? Because
let's hear.
Endowments over $1 billion, 32% equities, 7% fixed income, 58% alternatives.
Amazing.
So why is 60-40 appropriate?
Well, you need to come up with some rational benchmark.
True. So what do we think is fair?
Well, the problem with coming up with a benchmark for private equity and hedge funds is they're all essentially made up. They're fabricated.
What, the benchmarks?
The benchmark for hedge fund. There is no... So you have things like
because of self-reporting?
Right. You have a lot of survivorship bias. When they have a bad year, they don't submit it. So if you use there's a few of them, hedge fund indexes, they're all bullshit. They're all completely unreliable. We know there's a very non-Gaussian distribution of returns. Fat head, long tail, said in English, winner take all, handful of giant winners. This is true for hedge funds, it's true for private equity, it's true for venture capital, and then everybody else is an also ran an expensive underperforming fund. To quote Jim Chanos, 30 years ago, there were 100 hedge funds out there. Almost all of them created alpha. Today, there's 11,000 hedge funds. Those same 100 are the alpha generators.
So, again, we talk about the Ivy League endowments, but they can invest 100% of the endowment in negative yielding Greek debt, and they would be fine, right? They have $30 billion, $40 billion. So they have
Harvard is now over $40 billion. By the way, Harvard was recently passed by UTIMCO, which is University of Texas in Austin, and Texas A&M, and the Texas operating budget. It's $47 billion. They're giant.
All right, so they can do anything. They'll be totally fine. What about the rest of the gang? Like, so for instance, to these alternatives, the allocation goes down more and more and more as you go from $1 billion, from 500 to $1 billion, et cetera.
Meaning less alternatives when you're a mere billion dollar endowment.
I guess one of the issues that you bring up that is probably very valid is that they have unrealistically high expectations for private equity.
Right.
What was the stat? 94% expect them to beat, 94% of institutional investors expect private equity to outperform public markets. I don't understand this.
And look at the percentage of those, that 94%, who think it's going to beat by a giant margin.
78% expect, 23% expect them to outperform by 4% or more per year. That's
So this is very consistent, by the way, with expectations we saw for hedge funds a decade ago. We know hedge funds are going to outperform over the next decade, and we're going to increase the allocation to it. There seems to be two things happening simultaneously. One is human nature, and the other is markets. We'll start with markets first. We look at the CAPE ratio today for U.S. equities, about 29. We know we can't use a CAPE ratio as a timing mechanism, but it's fair to say a high CAPE ratio should lower our future expected returns. At the same time, we have the 10-year Treasury bond yielding less than 2%. That means Treasury bonds are pretty richly valued also. If you're running a large endowment or a pension fund, you should ratchet down your expectations for future gains.
Well, they have, which is why they're in these private instruments to begin with, because they know that public equities and bonds are going to have low returns. But they're delusional with their expectations for private investments.
So what they're doing is they're half right, half wrong. They're saying, hey, we're going to see lower returns from stocks and bonds, which is accurate. And then they say, I know how to fix that. Let's pile into private equity and hedge funds. Granted, they're more expensive and they tend to underperform, but that'll make up for this. Let me point out the most interesting thing is in 2017, according to a McKinsey report, over $700 billion fresh dollars were raised for new private equity funds. Reminds me a little bit about what's going on with the SoftBank Vision Fund, a giant pool of capital looking for the same home. In that case, it was small, mid-sized startups or large startups. Now you have the same thing. $1 trillion in private equity looking for a home. It's going to make everything pricier. It's going to make the returns worse.
It's too late.
Too late.
Why did you compare these high expectations to subprime mortgage investors? That seemed to me a bit of a stretch.
Well, think about what happened in the run-up to the financial crisis. You had rates post 9/11 drop to 2%, and not long after, it was about 1%. People were not getting strong returns in fixed income. Mm-hmm. But along comes subprime securitization with the following promise. This is just as safe as treasuries, but it pays 200, 300 basis points more yield. You could get higher returns without taking on more risk. Everybody ran into it, even though we all know you're not going to get higher returns unless you're taking much more risk. Do you think
that's the same story, though? Do you really think that investors don't know that they're taking on more risk with these deals?
It's certain. If you're 60% alternatives like private equity, right? The number you threw out before?
58% of endowments.
Okay, so someone moves.
Endowments over $1 billion, 58% of their portfolio is alternatives.
Do you think if you randomly grab a board member from any of those endowments, they're going to say, oh, yeah, we understand. We're embracing a shit ton more risk. That's why we put 60% in. They're all pretending, no. So there's a really interesting thing about private investments versus public investments. People confuse volatility for risk. A REIT goes up and down every day. Your house, you bought your house 5 years ago, you pay X, you'll sell it 5 years from now, you'll get Y. Oh, look, it's a straight line, but we know it's not. You just don't see a price quoted every day.
So we know why they went into these investments, and we know why hedge funds have had a tough time. What do you suggest they do? Just say, hey, we've been wrong all this time. We're going to buy index funds? That makes no sense. Why would they do that?
Well, I love the story that was in the Wall Street Journal a couple of years ago about the guy who runs the endowment.
Nevada,
the pension fund. One guy works in an office. He shows up every day with a brown paper bag with a tuna fish sandwich in it. He's in a 60-40 portfolio. He's purely indexed. I think he gets something like $150,000 as his salary. That's it. No consultants, no big boards, Think about these big endowments with all of their various patrons and all of the various alumni, many of whom work in finance, and think about how many millions and millions of dollars are wasted.
But it's not a performance thing. Like I said, they have so many billions of dollars. Ben did a post where he looked at endowments, millions of dollars per student.
Right. It's ridiculous. On a per capita basis, it's insane.
Maybe if they have over $5 million in endowment money per student, tax them, do something. But I don't necessarily think that the investments are like the sticking point here.
Well, I think it's a giant waste of money. When you look at a Harvard or Yale with $30 or $40 billion, they could literally, if they invested this better, smarter, cheaper, they could literally say free tuition for everybody who goes to school
but they're not doing
whose
that anyway.
parents make less than $100,000. Well, they're not, because this is all about keeping your job, if you're on that board, if you're on the endowment. This is all about appearances. This has nothing to do with the fiduciary obligation of an endowment to its school and to its current and future students. If you put me in charge, this would be really easy. Hey, you're in a globally diversified portfolio. We'll rebalance once or twice a year. We will do much better than any of these endowments will do.
That's great. You're fired.
I'm not going to be fired because I'm not going to work there. I'm giving this to them for free. Here, do this. Save $50 million a year in your overhead. Get better returns at less money. Stop jerking around with all this nonsense. I know it makes for great cocktail conversation.
Oh,
I know it's delightful at alumni meetings, but you're not doing yourself any favors.
Okay, so you say that all the time. It's great for cocktail party. Does that really happen? People talk about this at cocktail parties? I'm asking.
You and I are a couple of years apart. The 1990s.
All right, that was 30 years ago.
Okay, so the 1990s, it was all about tech stocks and eyeballs and this and that. In the 2000s, it was all about real estate and flipping.
What's it about today?
And commodities. Bitcoin for a while. That was the last big cocktail party chatter.
I think that this
Amazon.
Yeah, but my point is, I think we're making up this. We're making up this cocktail party talk. Like,
oh no! This was a giant thing. The difference was there's no more cocktail party chatter.
No, it's conference talk. Nobody talks at cocktail parties about investing.
Or barbecues or backyard gatherings. They used to look at Jim Cramer's show. Cramer, who I think is a fascinating character, that was straight out of the backyard barbecue. Now that mom and pop post-financial crisis
those days are long gone.
What?
Socializing and talking about the markets?
Those days ended when everybody took their ball and went home. And as I wrote before, by ball I mean their money, and home I mean Malvern, Pennsylvania. They went to Vanguard, they went to BlackRock. They're indexers. Nobody talks about stocks at cocktail parties or barbecues anymore. Right. But at alumni events, you can bet they're talking about, we have this much money in venture capital and this much money in private equity. That's where we're going to really shine, or so our consultants tell us. And we pay those consultants a lot of money. I think they were wrong about hedge funds for the past decade, and they're wrong about private equity now.
All right, good place to wrap up. Are institutional investors delusional in their expectations? Let us know what you think in the comments. Hit subscribe, and we'll see you next time.